Want to do this is bridge loans always come up, especially right now, because there's people sitting on a ton of equity in their houses. And a lot of people are waiting to try to figure out how to sell first or buy now, or they're not sure how to structure all that. And we've got a couple new options. So in the 15 minutes we've got today, we've got really, there's three ways for people to access that equity and buy before they sell. And so we want to go through what we think are the three best options out there. I'm going to start with the first one because it's the easy one that most of you guys know, but still the absolute least expensive way to get access to your home equity, to use it to purchase a new home or whatever, is to get a home equity line of credit on your house. Now, in some situations, that's not feasible because you've already listed your house. What you guys want to know about the home equity line route, and we've got some local banks that we can recommend. Credit unions are good for that kind of thing. Other people are good for that kind of thing. If people have a relationship with banks, but we've also got some options if people need recommendations. But obviously, if the people go to get their home equity line and the first thing they blurt out is, "Oh, I'm just getting this for a month or two until my house sells," they're probably not going to get the home equity line. So I always recommend, if they ask the question, you don't want to lie. You just say, "Oh, I'm thinking about investing in some real estate." That's a true statement. So that's a good way to do it, but you want to tell your buyers, if they're going to go that route, to not be too blatantly honest as they're talking to the banks and the credit unions. Most of these home equity lines of credit that you're going to go and get with the bank are going to have a prepayment penalty. The prepayment penalty is typically $500 to $600, which is cheaper than any bridge loan closing cost that you're ever going to find anywhere. So they're going to have a prepayment penalty. Don't panic. It's $500 or $600, and that's to cover that bank's cost of doing the appraisal. So it's an inexpensive way, and they just have to know that's a sunk cost going in. But the advantage of the equity line, of course, is you can pull what you want when you need it, only pay interest right when you need it. And you only make those interest-only payments until the house sells, and then that gets paid off along with your regular first mortgage, and you get the rest of your equity at closing. So far and away, and you guys probably know that, but I just thought little pointers in there. Also, if you've got questions, you can throw them in the chat, or you can wait till 2:15 and just make a note of what your questions are, and then we can chat with you guys about that. But that's the obvious one, is get a home equity line of credit. Now, if the house is listed, that will come up when that bank goes to open the equity line of credit, and they're most likely going to turn it down because it's on the market. So it would have your clients would have to know to do this before they've actually listed the house. The other two options are relatively new options that Fairway has just gotten, and I think they're both private labeled. Is that right, man? Are they both private?
They are, yes.
So it says that whether it's a Fairway product, it's not us, obviously. It's a third-party company doing these services, but we've got two other options, and I'm going to email everyone that's on the call a little flyer that's got these three options, so you don't have to worry about what they're called or how they work. Just know that that's going to be coming. So I'm going to let Van talk about the next two options, which are pretty interesting, and we just had somebody yesterday actually that's got one of these options that they said, gosh, it's not cheap, but it accomplishes what I want to accomplish, and it's better than it's cheaper than they thought it was going to be. So go ahead, Van.
Cool. So the first option I want to talk about, we kind of call it the trade-in mortgage. And so it's for folks who don't necessarily have to worry about the down payment, or they can figure out some kind of down payment to put down on the new house, but they're just unable to qualify with two mortgage payments at the same time. So maybe they really wanted to try to pull some equity out. They already had an equity line of credit, a HELOC, like Mark was saying earlier. So they really have that part handled. They just are unable to qualify with carrying both mortgages at the same time. Now that's not an issue. So with the trade-in mortgage, we're able to discount the existing mortgage payment to be able to help them qualify for the new mortgage payment, even though they haven't sold their existing house yet. And so how we go about doing that is that with the trade-in mortgage, that's kind of like what I'm calling it. What the company does is they go in and they write a backup offer on your existing home, and that allows the Fannie Mae guidelines to exempt that payment from their debt qualifications, and allows them to qualify. And so basically how it works is this company will come in and do sort of like an AVM model or an online model, sort of like a Zestimate. I call it the Mark Spain offer, the whatever you call it. So basically, they'll make a low ball, kind of like cash backup offer on your house, somewhere around 80% of the real value, and that allows. But it's a real backup offer, and that allows us to discount that mortgage, so that they can, debt qualify. Now, what's the cost for that? That's really always the main question. So, um, they charge for this particular option, it's like a $2,000 administrative fee, plus they charge 1% of the lowball offer, not the eventual sales price, but the lowball offer on the existing home. And they don't actually collect any of those fees until the existing home sells. So you just kind of make all this stuff. You can get your place closed. You can turn right around, put it on the market. And then if it doesn't sell, then I think it's 150 days, then this other trade-in mortgage kind of kicks in, and they'll buy the home at 80% of the value. They do have some equity protection, but it's a little limited. So they wouldn't, most folks are going to sell their home within 150 days, but they just need to be prepared to take a clip on the sales price if they overprice it or whatever. So in a nutshell, that's kind of like the kind of second option. Mark talked about the first option, the HELOC. Second option, we kind of call the trade-in mortgage. And then the third option, I kind of call the buy before you sell. That's for someone who can't necessarily qualify to buy the other house and they need the down payment, or they just need a creative way to come up with tapping the equity on their existing home if they don't have time to do an equity line or something like that. And so the kind of buy before you sell option makes a real fair market value backup offer on your house. Like I just closed one a week ago, and I think the ultimate listing price on the house is going to be like is indicated right around $1 million, and the AVM offer in the buy before you sell program was $975. So I mean, it's pretty darn good. So with that product, they allow you to access 75% of the home's equity, less whatever you owe on other mortgages, which is pretty slick. And the fees for that one is 2.4% of the eventual sales price. So that one's kind of pricey, but there's no fees or interest or anything on the bridge loan that they offer you to pull the equity out. So when you kind of add all that together, I mean, I kind of say it's kind of like adding a third realtor to the sale of the future transaction, but it just puts a deal on the table that wouldn't necessarily be there previously. Or in my client's case, they were having to liquidate some company stock, and the capital gains was going to be somewhere around 12% or something crazy like that. It was going to cost them a fortune. So this option, even though it might seem a little bit pricey, was way cheaper for them, and so that's why they did that. So just to kind of give a quick recap, and then I'll kind of open it up for questions. I know it. I just want to be respectful of everyone's time, so I'm trying to move quickly. But so the trade-in mortgage is where you basically just need help with qualifying, and then the kind of buy before you sell option is where you can have help with qualifying and access the home's equity. So both of those, or all three of those options are great, and they're just great tools to have. So go ahead, Mark.
Yeah, and I was gonna just another way to take you through the scenario. So in the second option, which is you just need help qualifying. I know that one of the questions we get a lot is, well, what actually happens with that? They put an offer on your house. They give you 150 days to sell the house. If you don't, you do sell it to them at about 75–80% of the value. But then when they turn around and go to sell that house, if they sell it at 100 or 110% of the value, they'll collect their fees and any expenses they incurred in selling. But other than that, and that's where Van mentioned equity protection, the extra money would go to the seller of the house. So they wouldn't lose it, but they give you 150 days. Obviously, you want to use these programs in a market where the house isn't way outside of Atlanta, and you're not sure how fast it's going to sell. It's great for markets that are hot, and the house is going to move pretty quickly. And then the second option, like Van said, they both allow us to exclude their current mortgage payment from their debt to income ratio. Both of these options allow them to do that. The second option adds in basically an interest-free 0 payment loan on whatever equity they have. So the person I talked to yesterday that thought this was really interesting is moving from Texas. He's got a house worth about $1 million. He has about 300,000 on it. And he can't qualify to buy here until he sells there, but he's not sure exactly how long it's going to be, but he's in a hot neighborhood. And when I talked to him about this, he's like, well, 2.4%. Yeah, that's 25 grand or whatever. That's a little expensive, but compared to my other options, it might actually be a really good solution for us because I can pull that equity, not have to worry about payments, not have to worry about paying any interest on that. And I just played a flat 2.4 when all is said and done. So he's like, if my house doesn't sell fast enough, that's a really good item, something to keep in our hip pocket. So I don't know if that helps clarify it, but yeah, we'll open it up to any questions you guys have now. If you know, I know we're getting close to our 15 minutes. So if you've got to jump off the call, then feel free to jump off the call. And you can raise your hand or you can put it in the chat, whatever works. Go ahead, Courtney.
So did you guys may have said this, but for the buy before you sell option, does that one also have a certain period of time that you need to sell the house within?
120 days.
120?
Yes. So
Okay.
4 months and 5 months, isn't it? 5 months for the first option and 4 months for the second option.
And then same with that one, if they end up selling it for more, do they like minus out their expenses to sell
Well,
it?
They're just a flat 2.4%. So, but yeah, I believe that there's equity protection on the second one as well, right?
Yeah, there is. But the way that works is if you don't have it, the second option is if the closing doesn't happen before 150 days, they're buying it. There's no, there's no options there.
Okay.
In the buy before you sell, where the 2.4% one, they let you list the property with whoever you want. If the property doesn't sell within 120 days, they come in and basically just purchase the debt, and then they let you put it right back. Like if you listed it, then they just let you put it right back on the market. Except they're the seller, and whatever fees that a normal seller would incur, commissions or whatever, they'll take that out. I mean, and they control what offers they get accepted as well, because they're the seller then. But they do have equity protection on that one as well. So if there's an overage minus whatever the fees are, then it goes back to the original buyer, which is very nice. And the way that I always kind of phrase that is they get paid a 2.4% commission. They don't want to take a low ball offer. You know what I mean? So it's not in their best interest to lowball it because then they just get paid less. So that's a great question.
I just emailed everyone these three options on a flyer, so you've got a PDF of kind of what they are to help refresh. Any other questions from anybody?
Yeah, I'd have one, Mark, if you don't mind.
Sure.
Van, you just got a clear close on a loan for my client who he very easily could have added his wife and saved some stress about the contingency of selling it. It all worked out.
Yeah.
But I really pushed for a bridge loan to get his wife on there short term, take her back off. His reaction to a bridge loan was he's shocked. He says, there's absolutely no way. It was way, way too expensive. I've not done a bridge loan with a client. So if you can let me know why he said that, what's so expensive about a bridge loan? Or is it not and he just felt that way?
Yeah, I don't think they're really expensive. I mean, it just, we talked about that. And, if the dates had gotten closer together, we would have probably been talking about it again. You know what I mean? Because he would have had to do what he had to do.
Right.
But so like for just the like it just gives you 2.5, or it's a 2.4% commission. So I mean, it's like adding a third realtor basically.
Okay.
So, to him, I just think he was thinking that, well, I'll just talk the seller into doing contingency.
Okay.
I mean, but as we got, and I get that, like everybody has their own perspectives, and I totally respect that. But, in the situation to where his sale would have been bust, then it would have gotten very cheap, I think, in his mind, because he's either going to lose the house or he had to make, we don't use these that often for a bailout situation, but they work great in those situations as well. The one thing that I would mention is that they are very fast and they are very low frills. Like you don't have to jump through a bunch of hoops. There's no person that's an underwriter. It's kind of like an AI type of model. You fill out the application, which I basically do for the clients. I send out all the documentation for the clients. For the one where they're taking the bridge loan and and the buy before you sell one, the last one we talked about,
Huh?
they do have to subject themselves to a home inspection that they do not have to pay for, but they just want to make sure the property is what you say it is, which is typical, no big deal. But there's no upfront fees or anything like that.
Okay,
So they had to upload me some pictures, which their realtor did. I mean, it's very low labor intensive. Like it's very simple.
But on $1 million house, Corey, that's 24,000 in extra expense. So it's
Yeah.
not inexpensive, but it could be compared to losing the house or that guy that's paying the capital gains tax or,
right.
it could be depending on your situation. It may not, it may be worth 24,000 to save your $1 million house that you love. And, it just depends on the client, right? I mean, that's why I said the absolute cheapest way, if you can afford it in the debt to income ratio, is go get a home equity line of credit.
Absolutely.
It costs you $500 in prepayment penalty, and then you can pull your equity out early. But you then have to be able to qualify for your current mortgage payment, the HELOC payment, and the new mortgage payment.
Right.
And so you can't do that. These two options allow us, they only have to qualify based on their new mortgage payment. Because we have an offer on their house, we can exclude the debt per Fannie Freddie guidelines.
Yeah.
And one thing I'll add to Corey's situation is I had literally the exact same situation, except seller wasn't cool with it. There was no contingency, right? I mean, so that's Corey, you worked that out because you're a rock star agent, but it doesn't always go that way, right? So
Right. And I was also struggling with his wife wanted the house more than God. Friends of their kids live right next door. She's becoming friends with the mom next door. He was like almost, if it doesn't happen, it doesn't happen. So and he was not holding the ball. So he wasn't as motivated or under the gun to make sure that this happens. And fortunately, we did work it out. It went great. So and thank you for a good job on that loan with them. I mean, it was great.
Absolutely. That the cost situation is something that we always talk about because like Mark was saying, there's multiple options, right? And so the one that I closed a couple of weeks ago, they had multiple sources to be able to make it work before they sold. They were fortunate enough to not have to worry about qualifying, but to them, the way just the cookie crumbled, it was just the cheapest option.
Okay. How long, if he wanted to go the cheaper route and get a HELOC, would that have slowed him down?
Yeah, it takes about 30 days to get a HELOC closed, typically.
Okay.
With a bank.
Right. Okay.
Yeah, some places can do it 2 or 3 weeks, but you've got to catch the buyer on the very beginning end when they know they're going to need their equity before they list their house, and then they've got to go apply for the HELOC, get it, and close on it. And that has to happen before the closing on their new house, obviously.
Right. A contingency could actually sometimes go faster, depending on the house. And in this market, it's pretty fast anyway.
Yeah, most of the time it happens exactly like your situation where they're thinking about listing their house, and that's talks, just like these guys were. But then they found the new house, and it's speed. And you got to figure out what to do.
Yeah.
So that's where these options come in super handy. Not always necessary, but super handy if you need it.
Right. Okay.
Anybody else have any more questions for us? Okay, well, everybody should have that email. Thanks so much for joining, and we'll let you guys know when we're having the next one.
Thank
That's really
you.
good.
Thanks, everyone.
Thank
Bye,
you.
guys.